In a world where economic warfare is increasingly common, sanctions have become a double-edged sword. By the end of this video, you will understand why sanctions often fail to achieve their intended outcomes and how they can spiral into broader crises. With stakes as high as national security and global stability, it's crucial to see why history repeats itself in this context. Sanctions are now a primary tool for international diplomacy, especially concerning geopolitical tensions with countries like Russia and Iran. In an effort to curb their influence, the U.S. has imposed sanctions on these nations, hoping to bring them to the negotiating table. However, the approach is often haphazard, leading to unintended consequences that can destabilize global markets and hurt civilian populations. To understand why this happens, we need to look at historical parallels where economic warfare had unexpected outcomes. Take the case of Weimar Germany from 1921 to 1923. Following World War I, Germany was forced to pay massive reparations. In an attempt to meet these obligations, the government resorted to printing money, which led to hyperinflation at a rate of 29,500% per month at its peak. Workers were paid twice daily as prices doubled hourly, wiping out the middle class's savings and leading directly to political instability that enabled Hitler's rise. The underlying mechanism behind these failures is the trade-off between short-term geopolitical objectives and long-term economic stability. In both Weimar Germany and more recent cases like Zimbabwe, 1999-2009, where land reform destroyed agricultural output, governments printed money to cover deficits, leading to peak inflation of 89.7 sextillion% in November 2008. The economy only stabilized after abandoning the Zimbabwean dollar entirely. These historical patterns reveal that sanctions often trigger severe economic responses that exacerbate crises rather than resolve them. The same trade-offs are seen today with Russia and Iran. Sanctions aimed at curbing their influence can lead to hyperinflation or a black market, where goods flow despite official embargoes. This non-obvious insight is critical in understanding why sanctions often backfire. The lesson for today is clear. Economic warfare through sanctions must be carefully calibrated to avoid triggering uncontrollable inflation and political instability. By learning from history, we can better anticipate the risks and manage them more effectively. Understanding these dynamics will help you navigate future geopolitical tensions and recognize when sanctions might do more harm than good.